I want to welcome you to Financial Training for Business Owners. Today, we'll focus on 6 quick ways that we can lower your cost of goods sold. In a previous session, we outlined these 6 factors that directly impact your COGS. As we previously explained, there are only 3 numbers that you really need to focus on in any P&L statement. They're the ones highlighted in red: revenue, COGS, and overhead. The reason these 3 are so important has to do with the simple fact that these 3 are the only numbers in your P&L that you can directly impact. The remaining 4 numbers are all determined by these 3. You find gross profit by subtracting COGS from revenue, and then dividing that number by the revenue gives you the gross profit percent. When you subtract your overhead from your gross profit, you find your net profit, which you then divide by revenue to determine your net profit percentage. So, the 3 numbers that you can directly impact, and the ones we're going to focus on to help you make dramatic financial gains with zero cost, are revenue, COGS, and overhead. We then discussed the power of exponential growth. In this example, if we could impact these 3 areas by 5% each, meaning we increase our revenue by a meager 5% and lower our COGS and overhead by 5%, we would generate an additional $27,000 in net profit, and at zero cost. So now that begs the question, how can we increase revenue and lower our COGS and overhead? The good news is there are multiple ways to impact each of these 3 areas. So today, let's focus solely on the best ways to lower our cost of goods sold. This is an extremely important area to really delve into. Why? Well, both revenue and COGS directly impact your gross profit, and your gross profit pays your overhead and is responsible for generating profit in your business. Today, we want to show you your options for overcoming these 6 factors, and in the process, lower your COGS and increase your profits. Factor number 1 involves misunderstood pricing. Make sure you're using margin pricing properly. We used this example in a previous session. Let's say you sell widgets, and to build each widget costs you $100 in materials plus $75 in labor. So your cost of goods sold equals $175 per widget. You decide you want to make 35% profit on each widget you sell. So you multiply your $175 cost times 1.35, which equals a price of $236.25. Now this is how most business owners set their product or service pricing. But when we plug our numbers into our P&L template, we discover our gross profit percentage is only 26%, not 35%. This means you're only generating about 75% of the profit you were targeting. Now obviously our original formula where we multiply our COGS by 1.35 is wrong. What's the correct way to determine a 35% profit margin? Well, you must use the inverse to calculate this properly. To find the inverse, you simply take whatever profit margin you're targeting and subtract it from 1. 1 minus 0.35 equals 0.65. So our new formula for determining our price is to take our $175 COGS and divide it by 0.65, which equals $269.23. Now, is that the right number? Well, let's plug it into our P&L template and we'll find out. Our new price of $269.23 is the revenue each widget will generate. We now subtract our $175 COGS and we get our new gross profit of $94.23. We then divide $94.23 by $269.23 and we find our gross profit percentage is now 35%, just what we were targeting. But suppose you have no idea what your profit margin should be for your business. Well, try this. Use Google. Just Google your industry or profession. Let's say you're an accountant. Just type average gross profit for accountants. You will often find multiple sources you can refer to. This will at least provide you with some guidance and let you know if you're in the ballpark with your current pricing. But what should you do if you find you're far below your industry average and you truly believe your area won't support a price increase? Well, consider using a bundling strategy. Product bundling is a great strategy to use when you want to create additional value for your business. Product bundling is simply the process of grouping together certain products to create packages, which you then sell to your clients. Now when you do this, you create an apples to oranges comparison with your competitors. and completely remove price from the equation. I'll show you an example of this in just a moment. Misunderstood pricing can have a major impact on your cost of goods sold. Be sure you double check your pricing for all of your products or services to ensure you're generating your desired profit margins. Now let's move on to our second option that can lower our COGS, discounting. There is no faster way to utterly destroy your profit margins than by discounting your price. As we showed you in a previous session, if you discount your price by a mere 10%, you may find that you need to sell 50% more just to break even. The entire premise behind discounting is flawed. It assumes that price is more important than value, and it isn't. Prospects shop value, not price. The key here is to innovate your business so you offer more value than your competition, even if that means increasing your price. Yes, you heard that right. Increase your price to reflect the true value you offer. Consider this example. Let's say a restaurant offers you a 25% discount on your favorite meal that costs $60. The restaurant next door has your same favorite meal at the exact same price, but they include a bottle of wine and your dessert for free. Which restaurant would you do business with? Well, the vast majority of people select the restaurant offering the wine and dessert. After all, it's the best deal, isn't it? The restaurant offering you the 25% off your $60 meal is a savings to you of $15. But at the second restaurant, the bottle of wine is listed on the menu for $25 and the dessert is $6 each. Therefore, you perceive that you're saving $37 instead of $15. Now, that's quite a deal. So now you're asking, how can the second restaurant afford to make such a lucrative offer? Well, they can do it because they know their cost. That $25 bottle of wine only costs them $8 wholesale, and the $6 dessert, maybe $1 wholesale. Check out this comparison chart for both restaurants. Restaurant A charges $60 for their meal for two, and their profit margin is 50%, leaving them with a $30 profit. But that 25% discount costs the restaurant $15 of that profit, leaving them with a total profit of just $15. Now compare that to Restaurant B. They offer the same meal for two at the same $60 price with the exact same margin and profit. But the wine and two dessert freebies only cost the restaurant $10 total, leaving them with a profit of $20. So the profit for Restaurant B is 33% higher than A, $20 versus $15, but look at the perceived value from the eyes of the customer. The 25% discount offered by Restaurant A has a $15 perceived value, while the wine and dessert offerings have a $37 perceived value. The second restaurant only spent $10 and yet still created the perception that their customer was receiving much more value for their money, $37 versus $15. In terms of value, that's a stunning 247% value increase over Restaurant A. So in this example, both the restaurant and the customer come away winners. And once Restaurant B promotes this offering in their marketing, they will create a market-dominating position. After all, who will want to pass up receiving $37 in free stuff on a $60 meal? And yet the restaurant is spending less overall than the restaurant providing the discount. This is one reason we're not a fan of discounting as such. Naturally, you must consider your circumstances and the situation, but overall, you're much better off offering something with a high perceived value but a low cost to you overall. The key is to create added value in everything you do. Prospects and customers don't buy based on price. They buy based on the value they receive for the price they pay. Creating additional value is a marketing or customer relations strategy that can take the form of a product or service that's added to your original offering for free or as part of a perceived discounted package. This example highlights the product bundling strategy we referenced when we discussed pricing at the start of this session. Bundling is a great strategy to use when you want to create additional value for your business. Now, our third option for lowering our COGS is to confront supplier price increases. Yes, suppliers do raise their prices, often to cover labor costs or their own supplier price increases. These increases typically aren't dramatic. They're usually small incremental increases that most business owners might not notice. 2 to 5% annual increases are common, and many business owners just shrug these off as no big deal, when in reality, these are huge deals when it comes to your bottom line. In our previous session, we demonstrated how a mere 5% supplier price increase impacted our company's bottom line by a staggering 15%. Here are a few suggestions to get these increases under control. Begin by obtaining competitor quotes. There are always additional suppliers for your most commonly purchased products and services. And believe me, all of them want new customers and will readily discount big time to get your business. If you have built up a relationship with your current supplier and you don't want to fracture that relationship, seek new quotes from the competition and just ask your current supplier to match it. They understand you're a business owner and need to keep costs under control. If they truly value your relationship as much as you do, they won't think twice about matching the lower quote. Once you obtain those competitor quotes, offer to sign an annual contract where you will guarantee to buy a specified amount from them annually in exchange for even lower pricing. If you have the funds available, you could offer to pay for the year up front in exchange for further discounts. Just make sure you know you're dealing with a reputable supplier. Now, if your annual volume is large enough, ask for bulk discounts. Most suppliers offer quantity discounts, but they may not publish that fact. Always ask. Next, investigate group purchasing through various associations. ARP is a great example of this for those over 50 years of age. ARP is an association that offers a multitude of group purchasing discounted products and services, everything from auto and life insurance to dental, vision, and travel. Just Google purchasing associations or procurement professional associations and see what's available for your industry. Once you negotiate your supplier pricing, see if you can negotiate longer payment terms. If your current supplier has a payment due upon receipt policy, ask about 30-day terms. 30-day terms is interest-free money for 30 days and can help you with managing your cash flow. If they already offer 30-day terms, ask for 60. Today's business environment is cutthroat. Suppliers are often willing to extend your terms of payment to ensure you don't jump ship. All of the suggestions above are proven and tested ways for you to successfully confront supplier price increases. Now, our fourth option for lowering our COGS is to keep your returns in check. Most products and services include a warranty, and if they fail to produce as advertised, consumers will return them for a refund. It's imperative that you keep a sharp eye on your return rate on a weekly basis. If you begin to see an increase in returns, immediately investigate the reason for the failure. Did it involve defective parts, or does it appear to be an employee problem, such as a lack of motivation, a lack of training, or perhaps the individuals responsible simply lack the necessary skills to do the job properly the first time? If your investigation reveals the cause for the returns involves defective parts, don't simply replace them and shrug it off as a normal part of doing business. Send the defective parts back to the wholesaler or manufacturer and demand a credit. If the problem persists, investigate alternate suppliers. Be sure you look for a proven track record of product reliability before choosing another supplier. However, if your investigation reveals the problem is indeed employee-related, make sure the training you provide is sufficient and updated. Does a segment of your training provide for on-the-job training? And if you find the issue has nothing to do with training, but instead the attitude of the employee, then decide if disciplinary action is warranted or possibly termination. Now, scrap is our fifth option for lowering your COGS. Scrap has the same cost impact as returns. It increases your material, labor, and opportunity cost. The way you deal with this is similar to returns. Begin by investigating the reasons for the failure. Was the scrap produced due to defective tools or processes? Did the defective parts play a role? Or is it a lack of training or a lack of skill on the part of the employee? If you find the problem to be defective tools or parts, seek immediate compensation from the supplier. If this situation continues, investigate alternate suppliers. If it turns out to be an employee problem, it may only require additional on-the-job training. But don't stop there. Determine if the scrap produced can be recycled or reworked. And always seek out your employees' feedback and suggestions regarding ways they might suggest eliminating scrap. They're on the front line day in and day out. You can bet they have specific and innovative ways your scrap could be dealt with. Now, our sixth and final option for lowering your COGS is excess inventory. At times, businesses may overproduce in anticipation of increased sales. And if those sales fail to materialize, you end up with excess inventory. Often, excess inventory is stored randomly wherever room happens to be available. So begin by investigating all storage areas and creating an inventory of what's available currently. Clean out everything that's outdated or obsolete. And finally, organize your stockroom and storage areas so your inventory is current and easily accessible. If you have excess inventory that you have no use for in the near term, determine what can either be repurposed or sold. Try to find some way to turn all excess inventory into revenue for your business. If you have to sell off inventory at a discount, make sure it doesn't replace a full price sale. The last thing you want to do is to offer excess product at 50% off and lose out on a full price sale because of it. If your excess inventory is unsellable, donate it to charity and claim a tax deduction. This is an excellent way to monetize inventory that would normally be discarded. Now, once all of this is accomplished, consider spending a few bucks and install an inventory management system. There is software available that can help you with this at extremely affordable rates. But ask yourself this: is it an absolute necessity for you to carry any inventory at all? Many businesses today have simply stopped carrying inventory. They've switched to a just-in-time inventory system. JIT is a management strategy that aligns raw material orders from suppliers directly with production schedules. Companies employ this inventory strategy to increase efficiency and decrease waste by receiving goods only as they need them for the production process, which reduces their inventory costs. However, this method does require producers to forecast their product demand accurately. Consider if this works for your business. So to recap, there are 6 areas to consider when looking to reduce your COGS: misunderstood pricing, discounting, supplier price increases, warranty and returns, scrap, and excess inventory. I hope this session has made you vitally aware of the financial damage small cost increases can have on the profitability of your business. Next up, we'll show you multiple ways to lower overhead, how to lower your supplier and vendor cost. We'll reveal to you the secrets of outsourcing, and is it better to lease versus own? And listen to this: we want to explain a legal loophole for US-based businesses that can save you tens of thousands of dollars every year, along with various hidden deductions you're definitely overlooking. This next session will be a virtual goldmine for your business. So until then, here's to your success.